You're building the empire
and we'll help you protect it.
because even the most powerful women
Still have trust issues.
Well, welcome back to another episode of Trust Issues, where, look, this is a place where money meets mindset,
Yes.
legal meets legacy, and power meets protection. We're all about protecting what you have worked so hard to build. I am one of your hosts, Erica Hall.
And I am your other co-host, Urenia Ricks Johnson.
All right, let's get into it. These are the things that we may not directly do to service or the things that we focus on. But today we're going to get into something that affects each and every one of us. We know it so personally. We're going to talk about debt.
We're going to talk about that.
Yeah.
And it does. Like you said, it affects all of us.
Oh, my goodness.
At every phase in life,
Yeah.
debt affects us.
Yeah.
Right?
So listen, y'all, this is the podcast where you get EH Wealth Advisors and
Attorney Urenia Ricks Johnson with Ricks and Associates, PLLC.
PLLC. Yes, you're getting the financial and the legal know-how, but sometimes you get into too much debt and you have to go see the attorney about that.
Yeah, you have to do a reset.
Yeah,
right?
you gotta
And we
do a
talked about
reset.
that with bankruptcy. And, sometimes that's an option. And it can be if debt is not managed correctly.
Yeah, I love when we did the show. You got to check out the show. We'll put a link in the notes, but where you broke down the know-how, why you want to do the reset and how to go into it. But if you are still in a place where you're just learning to manage debt, managing money, to me, managing debt, learning how to manage it is so important when it comes to financial management, because guess what? We live in a debt-based economy.
We do. And I don't think a lot of people understand that about our economy and how it's centered around that.
Oh, yes.
It's definitely centered around it. So you have to, it can be used effectively, though.
It can. You can learn how to manage debt so that it works to your advantage. You want to be aware of it. I think one of the greatest disservices that we have as a community or as individuals is we get into debt and not even aware of what we're getting into.
Right. And it can snowball so fast.
Yeah.
Right? Because we don't understand that we can manage it and it can work to our advantage. But a lot of times we don't realize it until we're in it so far.
Oh my goodness! I think we talked about our first credit cards on campus. I was 17.
College life.
I was 17 years old. They weren't even supposed to be giving me a credit card, but they did. And oh my goodness, then the shopping started, the harassment when I didn't pay my bill, all that kind of stuff. But let's be real. Many people are drowning in debt, and it's not because they're reckless. It's because of lack of knowledge, or it could be because of job changes, inflation, medical bills, child care, and sometimes just because we're just misinformed.
And just about life. And I just think about it, even from the simple things of, I have an 11-year-old son, and just explaining to him about, and we just, opened up his bank account and things like
good.
that. And so at the basic level, he sees us using credit cards, and he's just like, well, can't we just use the credit card?
Yeah, they don't understand.
That is the response of, well, mom don't have no money right now. Mom got a card.
Right.
Understanding that you have to pay that back, but it's just that simple of the concept that I think sometimes how we approach that and not even thinking about the fact that there's going to be a cycle a day after this where it's going to become due.
Yeah.
And making sure that we are prepared for that. It's okay
That's
to
good.
use it, but at the simplest part of it, understanding that when you use it, there is something that happens after that point.
Yeah, it's definitely so. That's good. And from an 11-year-old, that is, there's an opportunity, a teachable moment, right? So let's talk about just being aware of debt, and because debt can be a tool It can be a tool. It's how we are able to purchase large items such as a house or a vehicle. You know, there are different financing options and different financing tools that these institutions use to make these payments affordable and things like that. Otherwise, we wouldn't be able to buy that $250,000 house or that $50,000 vehicle. But isn't it interesting? I always say this. Isn't it interesting how a $50,000, you remember when homes cost $50,000?
I remember.
How you could do a 30-year mortgage on a $50,000 home and you could pay off a $50,000 Navigator in 5 years? Isn't that interesting?
Wow, that's very interesting.
Yeah.
At the comparison of the amount, the payment amount, the value that we place on those items, and comparable to, you know, I think that it was when I first started practicing law, I was working with the UAW Legal Services, you know, the big three.
Yeah, that's good.
And the concept and the mentality of individuals was, you know, I was helping individuals to file for bankruptcy and then think about certain things. And when I mentioned, okay, well, maybe you have to give up this car, it was like I cussed at them.
Yeah.
They were like, what do you mean? I was just like, well, you can't live in the car. But the mindset was, you can do anything else, but you can't touch my car.
Yeah. Yeah.
You can't do anything with that. So it's amazing to me how, you know, people place priorities on different things, and that's how they get into debt.
Yeah.
You know, it's based on what your priority is. Whether you want that item now is based on that, or whether you can wait on it and pay for it in the traditional way, or whether it's a long-term thing where you know and you can count on the fact that even if something happens, I can continue to pay. Or some people just don't care. They're just like, bring it up.
Yeah. So I think that's the part about awareness, because these calculations, or what I was alluding to with the $50,000 house and the $50,000 car, is there's different there are different tables or what they call those sinking funds of how they calculate your payment. And if institutions are doing that, so should we. So should we. So the way that we are aware of how much house can we afford, how much of a vehicle payment can we afford for 5 years? 30 years is a long time, right? And it depends on the perspective that you have in going into purchasing these large items. You may not plan to be in the home for 30 years. And so you may be looking at this home, this real estate as an asset that's going to appreciate, that you're going to leverage for something else down the road. And so those are factors that you're considering when you're making these purchases, not just I like this house or I like this vehicle.
Yeah.
It needs to make sense financially. And so we need to approach all of those purchases when it comes to going into or financing or going into debt for a purchase. We need to approach it with awareness of how much home can we afford? How does it fit into my budget? And then how am I going to have to manage my cash flow in order to make these payments in consideration of all the other obligations that I have, such as child care or student loan payments, or what it costs for me to how much I like to go out and eat, or my lifestyle.
Right. And I think it's just like you said, it's the awareness, and then it's also the planning.
Yeah.
I think a lot of times we don't plan for when we are filling out those applications, looking at those things and being awareness. We're not planning for the what ifs. We're not planning for just making sure that we're able to take on that obligation and take it on successfully.
Yeah, definitely. Because I don't know about everyone else, but sometimes the newness, when it wears off and you're like, I'm stuck with this payment. I'm stuck paying for something that I'm not even as excited about anymore. And when I think about, do you lease or do you buy your vehicle?
So I lease my vehicles, but I have more than one.
Okay.
Right. But I am actually, just to be transparent, I am actually I have one through my business.
Yeah.
And then I have one individually that I lease. So right now the lease is up with my personal vehicle, and I'm weighing out the options. I'm counting up the cost to say, I really like the Lincoln that I have.
Yeah.
So I'm thinking about just actually purchasing it, so that way I will just have one car note.
Yeah, yeah.
And not have to worry about, the sustaining the long term and just getting that one paid off in a good period of time. So then that way we'll always have that vehicle.
Oh, that's good. That's good. So,
Yeah.
Okay, so I'm going to dig a little deeper. So why'd you consider the lease versus buying?
My consideration I was always a girl that bought, but then with the lease, I like the fact of having new cars every couple of years.
Okay.
That was one of the considerations.
Yeah.
The price point. Because the price point was it was very much in the budget where I knew that I could afford it, even if things got a little rough.
Yeah.
I knew that it would not be a strain on me.
Okay.
So those were the main factors of doing a lease as opposed to a purchase.
Yeah.
For me.
So when you went into it, did you do like a little calculator to see what the payments were going to be versus the lease versus buying, things like that?
And then I also did it with their finance company and then with my own.
Yeah,
I compared it with my credit union and with my bank to see before I went in with them to see what they could do.
Oh, that's good. That's good.
So, trying to count up the cost on what
I think that's great.
And then what season we're in, Now it was at the right time for me, because normally I just had personal vehicles.
Yeah.
But it had come to the point in time that now the business is in a financial season, and I had to evaluate the business and say, hey, I think that this is something that we can take on because of the cash flow that's going on with our business.
Yeah.
In order to take this on. And this is really so that's what has helped me to kind of reevaluate, okay, well, I don't need two leases. I can just purchase my own vehicle and then just kind of have that as an evaluation to make sure that I knew that I wanted to make sure that I had more than one, especially because I like the fact of just being able to switch it up. I like the fact of being able to always have a car.
Yeah.
Flexibility. What about you?
I'm just the opposite. We had a lease, my first lease, and I just remember we did so much driving that we went over the miles. I've always that's been my only experience with the lease, but I've always been a purchase.
Okay.
Buy the vehicle. I never buy a brand new vehicle. So I was taught about how to buy vehicles from my uncles. And
okay.
They
so
all
what did they say? What did
they
uncles
all worked
say?
at the big three. They
Okay.
said never buy a brand new car.
Okay.
Buy it after a few years, like a gently used vehicle, and purchase it. So they were. I had one that worked at Ford, one worked at Chrysler, and one worked at GM.
Okay.
And so
You had all the big three,
all
right?
the big three.
Represented.
Yeah, represented. And so they had such an understanding of the quality of the vehicle. They said, if you pay this vehicle off in 4 years, you could drive it for another 5-6 years, because they were lasting that long. Right. And so that was my approach. And I would say that the quality of the vehicles, I'll drive a vehicle for about 7 years until next thing I know, I paid the vehicle off. I'm driving it around for at least 3-4 years without a car note. And so that's been my experience. And so I keep a vehicle for about 10 years.
Okay, and that's a good thing. And that's the reason why I said, even with my experience, that I wanted to go ahead and just purchase the Lincoln. And just have that experience of now that because especially it will be at a better price, because it's of the value of it and things like that, to just keep that as my vehicle. And then if I wanted to do a lease where I'm not putting too many miles, because I have the other vehicle, and then I can get a vehicle that I kind of want and kind of be able to do it. Plus, my family likes to travel together. So that was another consideration of having a bigger vehicle. Is that we could do a road trip together and things like that. And even if we did that, I could still, if I wanted to not drive it as much, I could still drive the other vehicle.
Yeah, that's good. I think we just presented which was why I asked. I was glad to hear you talk about the lease, because sometimes it makes a whole lot of sense, especially like I hear different people, mostly women, who tell me about why one of the reasons they get the lease is because they like a dependable vehicle all the time. right? If you're getting a newer vehicle, in every 2 to 3 years, then it's highly likely you're going to have a dependable vehicle, and you don't have to worry about that maintenance.
Yes, and you have that warranty.
Yeah,
you don't have to worry about like the warranty. You can just take it there. The oil change are usually used for it's definitely a convenience, and I do like, even from the Lincoln standpoint, I love the valet service. I never have to take my car in.
Yes,
they come and get it.
Yes,
give me a loaner car.
Right.
I don't have to worry about. I never have since I bought the car. I haven't had to go back.
Right.
To the so those things are
they
very good. The personal service.
Oh yeah, I agree.
You pay for. I think that is what drew me as well to the lease part of it. But I also think that if you are able to just have a backup and where you're not actually paying a car note for both, that would be. So that's my goal with purchasing the Lincoln, is so I won't have to.
Yeah. I think this is a really great example of what you consider, all the things that you need to consider going into your purchase,
right?
Whether you're going to lease or buy or rent, and what that appreciation, or if it's a depreciating asset, such as a vehicle. A car is a depreciating asset.
It is.
Whereas your real estate is an appreciating asset. So the consideration is very important. The payoff timeline, how it fits into your cash flow, as you talked about, that was a really great example. But when you find yourself in too much debt, sometimes you just have to, restructure. Maybe you can do the restructuring and you don't have to go file bankruptcy, but maybe you can put together your own strategy so let's talk a little bit about some of those strategies of getting out of debt or accelerating, putting your own plan together. I know most people are familiar with the snowball strategy.
Yes. And you can tell us a little bit about that. Tell us how that works.
Okay, so snowball strategy, I like to put everything into we did back in the day a spreadsheet, but now you can put it into a little application. Go ahead, use that fan, girl.
I need it, girl. I need it.
You can put it in an app or something like that, and then you can say, I want a snowball. And basically, snowball strategy is where you pay off the smallest balance first. You line up all your credit cards or all your debt, and then you list the balances and the interest rates.
Okay.
It's interest rates and balances and how much your payment, at least your minimum payments or whatever you're paying. Smallest balance first, whatever you're paying on that balance, once that's paid off, and it's really rewarding, you take that amount, whatever you're paying on that first one, and then you apply it to the next one in the list, and you continue so on and so forth until you've snowballed your way out of debt.
Now, when you're doing that, the consideration is, so once I pay, let's say I have a $2,000 debt, and I pay that off.
Yeah.
Now I'm working on the other. Is the concept to still be using that credit card that I paid off?
Well, I guess it depends on if you're trying to get out of debt. Then that's an obvious right. That's an obvious no.
Okay.
That's an obvious no. And the goal is so that, because what you're doing is you're really just trying to restructure things so that maybe you can position yourself to qualify for a mortgage or to purchase. Maybe it's time for you to purchase a vehicle.
Okay.
And now you need to make some funds available so that you can have that cushion.
Okay.
So that you can purchase, so you can make those monthly payments on your car.
Right.
Yeah.
And that's important too, because I think a lot of times people, when I advise people, they say, "Oh yeah, I got this, but I'm still using this card." So after they pay this off, then they're like, "Okay, happy. I paid this off now." They go back and use it. And I think that it's important to understand that you have to have a period of time where you just not use it. You just don't live off of this debt for a period of time if you want to get out of it, or if you just want to manage it.
Definitely. I know we're going to, when it comes to credit, managing credit, there is a strategy. And we're going to talk about that in the next show.
We are.
But I know that we also got to understand that there is a credit portfolio. Just like you can have an investment portfolio, you can have a credit portfolio.
You can.
And that's the management that you're talking about. So it depends on what the goal is. If the goal is to keep your balances below a certain amount so that you can keep a certain score.
Yes.
We'll talk about that. But the snowball, if you're trying to get out of debt, you wanna pay that off and not and quit using the card, not run it back up. Now another approach is called they call it the avalanche. And this is why it's so important to know what those interest rates are, because the avalanche strategy is where you're paying the cards with the highest interest rate, or the debt with the highest interest rate.
And that's important too, because those interest rates, and I think a lot of times we think that with debt is out of sight, out of mind. Like, when we get the statement, a lot of times we don't even look at what that interest rate is. We done forgot what the interest rates are on them. And we just pay it based on the fact, okay, I'm just going to go ahead and pay it. But just understand that we're really not putting a dent into it because the interest rate is so high.
Yeah. I think the interest rate over 29% is, or 29% is, I think it's usury. That's the word.
Yeah, the law does have a usury, but I'm not sure for sure what that is. But it's borderline.
It is. It is. I think it's like 33% or something usury, like that.
Yeah, and I think it changes. Sometimes depending upon what that
fine line is. Those little check cashing places on the corner, or in the neighborhood. And it's so interesting how the banking industry. Do you know that they own a lot of those check cashing places?
I don't doubt it.
That if you look at the parent company,
it's one of your banks that we probably bank with.
Yes, it's like they may not be the direct owner, but they're
the parent company.
Yeah,
and everybody is up under.
Right. Kind of like, if you do a fintech, a financial application or something like that, and then you see that there's a bank that is the parent company behind that technology. And so because their goal is to not allow anyone to not be banked.
Exactly.
Or not have to use these financial institutions to get access to your money.
Exactly. They want to create a monopoly where you have to go to them at every level.
Yeah,
at the lowest to the highest level.
So the best thing that you could do, is get a bank account.
It is.
Get a bank account so that when it's time for you to cash your check, and it's time for you to have your direct deposit, whatever, get access to your funds, or to manage your financial cash flow and things like that, you need to have a bank account. You need to have a bank account with a banking institution, a financial institution, and not just fintech. There's a difference. There is a difference. And so when I say fintech, I'm talking about a lot of these apps that many people use, a lot of young folks use, and I say young folks because these are the ones who come and they want to open up an investment account. We open up an investment account, and so they say I want to start saving, and they want to start. I encourage them to do like automatic deposit of whatever amount it is that you've decided that you want to contribute to your investment account, and they want to set up an automatic deposit. Well, we can't set it up with like a SoFi account or those fintech.
Right.
It has to be. There is a financial clearing system with routing numbers and account numbers.
There has to be.
And those fintech.
You can't set up a cash out.
No, it has to. No, it can't be. It can't be cash out. It has to be not a Schwab.
Okay.
Not a Schwab. It has to be a clearing that has a clearinghouse through the financial system.
Okay.
Yeah.
Yeah. And I think a lot of times sometimes it's just the convenience and the lack of knowledge of being able to go to these places, because they advertise to, or they seek after individuals to make it easier for them, make it where they don't have to go through the whole financial institution. They don't have to go into the banks. They don't have to do any of those things.
Yeah.
And I get it. It can be convenient, but just understand it in the long term of being aware of where that puts you at and the disadvantage sometimes that it puts you at from a financial goal setting perspective.
It does. It does. And so I know that we live in a debt-based economy, but I'm just going to lean on the word of God here a little bit. And and I think it's so significant that God tells us in Scripture that the borrower is servant to the lender.
Yes. And that's so key because we don't view it like that, but it's true because you're bound to it. And when it's servant, it's like you're bound to that institution. You have a connection with them whether you want to or not.
Yeah, like credit cards are unsecured with with real estate or something collateralized, but they can come take your house, they can come take your car, or they can just bug the hell out of you like they did when they was calling me when I was 17 years old with that credit card. I didn't pay the bill.
And then they can sue you and garnish your wages.
Yeah.
So they can force you can pay voluntarily, or they can make you pay involuntarily.
Yeah.
That makes you a servant to it because a lot of times you would want to do different things. And we talked about garnishments before and how that some of the garnishments are out of your bank account. So let's say you have a bank account. They can take all of the money that's in the bank account to satisfy that debt.
Yeah.
And that's legal.
Yeah. So we want to manage our debt because debt management is stewardship.
It is.
It's stewardship. And I think if you can, so that's basically what you are learning to do. You're learning to, if you learn to be a good steward over not only everything that God has blessed you with or entrusted you with, debt is something to steward as well.
Right.
Because it is the tool, it is the way that we're able to navigate this debt-based economy. Why is this important in a debt-based economy? Because that means this economy, the way that our financial system and structure is set up, is they attach your ability to be credit worthy or your credit worthiness based on how you steward debt. We aren't going to give you any more debt if you haven't demonstrated that you can be a good steward over it.
And that's what and we're going to talk about that in more in depth, but that's what your credit report is.
Yeah.
It's the ability, because I hear people say it all the time, well, I have good credit because I don't have any credit, but not in this society.
No.
In this society, if no credit is bad credit.
Yeah, exactly.
Because you haven't proven how you handle debt.
Yeah, it is.
And it is, you have to prove that you can handle it effectively in order to receive more clearance or more to be able to be a better steward over it.
Yeah, and I think what we're trying to, the point that we're trying to get at is, because I meet people who say, I stay out of debt. I don't mess with it. But then you want to participate in the things that requires debt. And so if you're going to participate in those purchases and those transactions, you got to be aware and you got to be informed because your debt plan is just as important as your paycheck, your you're looking at your bank account statement and it's all a part of that. And so I want to talk about some tools that people can use so that you can be more aware, so that you can be on top of everything. And just like you go on your phone and look at all those apps, these tools can be right there at your fingertips.
They can definitely help. And we have to understand that these tools are designed to help us if we use them effectively and we really take them into consideration when we're looking at our debt and our income.
Yeah. So the first one I want to talk about is you mentioned the credit report. And I know that we can get a free credit report every year.
Annualcreditreport.com.
Yes. You can get a free credit report every year. But what about when you get that credit report and you got all this stuff on there that needs to be monitored, and it's not a one time a year thing because there's so much maintenance in making sure that the information is accurate and that you're watching it. So I want to talk about Credit Builder IQ. Credit Builder IQ is a tool that you can use to help repair and build credit. And this tool is so cool because it points out some things that you need to pay attention to help you understand how you can, impact your credit score.
And that's great because it helps you to put together a plan. And a lot of times we see that we may have gotten into debt and we have a lot of debt going on, but sometimes we don't really look at it until we're trying to get something, trying to purchase something, or trying to move into a different segment in life. Now we're trying to play catch up as opposed to having something to monitor it so you can make good decisions and you're not trying to make decisions on a whim. And that's why I think these tools are so effective.
Don't make decisions on a whim. You want to be informed about and so when you think that if they stop sending you, they stop calling you, that it just disappears and it goes away.
Somebody else paid it.
No,
Okay.
it doesn't. It follows you. It follows you. It does, unless you go to the point where you're filing bankruptcy. But here's some things that you could do before we get that far. You heard about My Score IQ?
I have. I have it. I personally use it. I use it to monitor because I have and we both have this. We have our businesses that we have to consider as well as our personal credit and things of that nature. So My Score IQ is very good. I use it all the time and just try to figure out where I'm at. Can I move forward with something? Do I need to work on something if I have some goals in mind for this year or for next year? Then I look at My Score IQ just to kind of make sure that I'm not missing anything. Or if something pops up and I'm just like, what is this? And how did this get on here?
I like it. I started using it because of the credit monitoring as well. Because every time there's a inquiry or my score is changing, I'm able to just pull it up and it gives me all three credit bureaus reports. As well as you mentioned about, your business. And one of the things that I had to become aware of is when I first started out with my business, the things that I was able to do with my business was based on my personal.
It was based.
Yeah, it was based on my personal debt. And so, and in order for me to start building business credit or having it separate, I had to first show what I was doing personally in order to, that I could be credit worthy, I guess.
Exactly, and be a good steward personally.
I'm like, wait, I got a whole separate tax ID. They didn't care.
They didn't care. They were just like, okay, are you going to guarantee that this is going to be paid?
Yep, you're the person. So these tools, they aren't magic, but they provide the visibility that you need to see everything so that you can stay on top of it. That's my whole thing. If you're going to be aware, you got to have a place that you can go and see everything in one place. And I love these tools. And so if you are interested in taking advantage of these tools, Urenia and I have set up an account with these programs so that we can refer you to My Score IQ and Credit Builder IQ. I think you're going to really love it.
Yeah, and I think the great thing about it is that we use these tools. We're not giving you something that we don't use and we don't apply in our everyday life. And I think sometimes you get people that give you things, and I'm not saying that that's not good, but you have real life examples where it's been effective for us, and just understanding that debt is a character flaw. It's a math problem, right? And which means that it can be solved. There are solutions to your problem that we can help you with. My Score IQ, Credit Builder IQ may be able to help you with. So there are solutions to the issues that you may have with debt.
Yeah, and I think that as long as you, we talk about managing your finances, building, getting the bag, and building wealth, and all this is a part of that.
It's a part of it.
This is a huge part of it, and so I hope that you've gotten some information out from something you can take with you to help you build your resolve when it comes to managing debt. Manage your debt.
You can do it.
Yeah.
Yes, you can do it. So we hope that you have gotten some real life application, real life practical examples of ways that you can manage and handle debt effectively, because it can, like we talked about, it can be a great tool.
It can be a great tool. So listen, we're going to wrap this up today. This is Erica with EH Wealth Advisors.
And Urenia Ricks Johnson with Ricks and Associates, PLLC.
All right. So while you're building your wealth, we help you protect it, manage that debt.
That's right. We can help you.